Welcome to today's video. My name is Philip Iwima from PropertiSelect, and this is how I pick properties that outperform the Dubai real estate market. So, why Dubai continues to rank number one for best ROI on a global level, smart investments in Dubai from a macro and micro market view, facts, actual ROI, and risk management. For today's agenda, welcome and introduction, why Dubai versus global markets, returns and tax advantages, common pitfalls and facts, risk management and exits, and tips and checklists that you can apply yourself to the purchase of properties in Dubai. In short, my name is Philip Iwima. I'm originally from the Netherlands. I migrated to Dubai in 2016. As you can see from the picture, that was my first visit in February 2014. This was at the World Trade Center in Dubai. I have a background in financial technology for about 5 years in sales. And since 2019, I've been active in the real estate market. And a few years after that, I founded a real estate brokerage, and I'm the former CEO of the brokerage. It does about 10 million US dollar a month, and we've helped hundreds of clients over the past few years. My own portfolio is only in Dubai, and I own about 5 properties in Dubai, divided in different areas between off-plan and ready. Besides that, I'm a shareholder in Solidaire International. This is a real estate investment firm. They invest in several projects in the region, in the Middle East region. One of them is the Al Zora project in Ajman by the water. Next to that, founder of PropertiSelect Academy and AI Solution for UAE property market. And my mission is to equip investors with knowledge and solutions to buy with confidence and to succeed. So, why Dubai versus global markets? From a global comparison, UBS ranked Dubai again for the highest ROI versus 21 top cities in the world. That's 6.67% after tax. Whereas in other cities, obviously you still got to pay tax, but Dubai doesn't have any tax when it comes to rental income and capital appreciation of your property when it's owned on a personal name. Besides that, Dubai is in the top 5 of fastest growing cities globally. The overall market is considered to be elevated and not bubble risk, unlike other cities, and it is future proof. In terms of affordability, Dubai's average price per square foot is still considered low. It's less than $500 per square foot versus Amsterdam, which is 845, London over 1200, New York over 1400, and Hong Kong over 2400. So in terms of price per square foot, there's still a lot of room for upside. And we see many investors from these different cities are basically selling in other countries and shifting their capital to Dubai. So that's a very positive sign. Now, why should we rely UBS data? Well, UBS is one of the largest real estate managers in the world. They have a lot of market data. They have in-depth knowledge of the real estate market from a global standpoint. They have independent researchers. They have track records with research, and they are an independent party. Besides that, they are the largest privately held bank in the world with 4.2 trillion US dollar asset under management. And they have very trusted reports that they issue every single year that goes in a lot of depth. And they work with local data sources that are reliable in all these different areas. So the report that we are looking at is the Global Real Estate Bubble Index report. Furthermore, they have strong oversight. They are regulated by FINMA, which ensures compliance and integrity of the data information that we're looking at today. On top of that, I shared the data source down below. So, as you can see here in the UBS Global Real Estate Bubble Index report of 2025, Dubai is in the top 5 of the fastest growing cities in the world, and they are currently at elevated label, which means on the overall market, the risk is elevated, unlike other markets where it's at bubble risk. So it's obviously important to monitor this data and to be cautious when it comes to selecting property in the market, looking for prime location, looking for prime developers that have track record, something that we will be talking about later in the presentation. Very important, this is the second year that Dubai is being ranked number 1 when it comes to highest ROI. As you can see, the 21 cities are listed on the right-hand side. When it comes to ROI, or price to rent, it basically needs 15 years before the apartment of the same size needs to be rented out to pay for the flat. As I said, for Dubai, that results into 6.67%. and Dubai doesn't charge any other tax when it comes to that, unlike the other cities in the world. Here we have an overview of the reports from the previous years. So basically from 2019 up until 2023, Dubai has been ranked at the very bottom when it came to the value of the overall market. And since 2024, they've been going to, let's say, moderate risk. And now we are at elevated. So we need to be cautious in the market, but there's still plenty of good opportunity out there. Now, when it comes to migration and demand, Dubai attracted over 13,000 millionaires in 2024. Below, we see a snapshot of the millionaire migration, the expected millionaire migration globally, where it was expected 6,700 millionaires would move to Dubai, but this eventually resulted into 13,000 in just 1 year. Again, this is from the UBS data, from their global wealth report of 2025, as you can see on the right hand side. So what's interesting to see from the chart, that we initially were supposed to have almost double the millionaires migrating to Dubai versus the US, but it ended up being more than 3 times the figure versus the US. We see a lot of millionaires leaving the East, leaving UK, South Africa, China, India, and relocating to more strategic safe havens in the world, where Dubai ranks number 1. Also, since 2011, the Dubai population more than doubled. So we went from 1.93 million to 4.03 million in 2025. On top of that, the Dubai population is expected to be 5 million by 2030 and 7.8 million by 2040. So there is a lot of demand for Dubai, and we have a strong path for growth for the future years. Currently, Dubai is on track to reach that number. We're almost at 4.1 million citizens. Economic stability and safety. There is no political turbulence. It has a safe haven status. Dubai always remained very neutral and always welcomed everyone. That makes Dubai very attractive for different type of people, different nationalities. And we can also see that many different nationalities are actually invested into the Dubai market. Also, UAE ranks to be the number 1 safest country in the world. On top of that, the dirham, the local currency of the UAE, is pegged to the US dollar at 3.67, which makes the Dubai market, the monetary system, quite stable and easy to work with from a global standpoint. The infrastructure and the 2040 vision, as mentioned before, Dubai's leader, Sheikh Mohammed bin Rashid Al Maktoum, has a very strong vision, a 2040 vision. In 2021, Dubai launched its 2040 vision. They want to dissect Dubai into 5 urban areas. They are looking to increase the size of green and recreational areas in Dubai. So that's over 105%. And they have many initiatives that basically contribute to the living experience, the safety. They contribute to the population having a good environment to live in, to good healthcare, good education, good infrastructure. So in short, Dubai has a very strong leadership without the complex bureaucracy as we see in the West. Now, when we talk about returns and tax advantages, realistic returns in the overall market are 6.67%, but keep in mind that some property is performing way less and some of the properties are performing way more. So even though the average is great and it's 6.67%, the highest amongst 21 cities globally, which doesn't mean you can just invest your money in the market and it performs at almost 7%. By the way, for Dubai, this is after tax and for the income that we generate in Dubai. But when it comes to any tax payable in the country where you have your tax residency, this is always something to advise with your tax lawyer. Dubai charges no tax on rent, appreciation, and inheritance. So when it comes to gross versus net, the total purchase price, we need to look at the full picture. So the full picture also includes the 4% Dubai land department fee, or in Abu Dhabi, this fee is 2%. And in Ras Al Khaimah, it's also 2% and due at handover. On top of that, in the ready market, you have 2% broker commission. And in the off-plan market, the commission is paid by the developer. On top of that, we have some small notary fees. We have optional legal or conveyancing fees depending on the complexity of the transaction, mainly for ready market units. And we have FX conversion fees. So these are the conversions that you pay as a spread for changing your fiat from one currency to the other. Take GBP, take US dollar, Canadian dollar, euros, you name it. Always double check the quote you're getting and the spread that you're being charged, because often these are hidden spreads and hidden fees. But these are also costs that you ultimately need to include into your total purchase price. Based on that, you can only calculate a net ROI. Then other costs to the ROI are real figures versus claims. So basically, the claims often have gross return on investment, but we want to look at the net return on investment. So what does it mean? We'll deduct the service charge. So basically, this is for maintenance, management, facilities, and so on. And this is a dirham per square foot per year and typically charged per quarter. So you pay this through either the government system called Moloch, or you pay it directly to the developer, but it's all controlled by a regulatory body from the government. Other than that, we have some maintenance fees. This could be low, this could be high, depending on the type of property you're buying. And when it comes to short term, you basically have DIWA for electricity, water, and so forth, phone bills, maintenance, and management. Whether you pay someone to manage it for you, or you do it yourself, or you pay an external booking provider like Airbnb or Booking.com, these are all costs that you need to deduct from your return on investment, gross versus net. Very important. So also when we work with these calculations, always validate the calculations using the real market data to calculate the expected ROI. Now, when we move to common pitfalls and facts, the problem that a lot of people are facing is the right opportunity presents itself, but the investors don't know how to act and they become indecisive. They lack proper guidance and knowledge. This is a major issue in the industry. A lot of people, especially foreign investors that are trying to get into the market, are basically lost when it comes to the advice that they are getting. It's very conflicting. It's hard for them to validate the information they're getting, and they basically don't know how to validate information. So the reasoning lacks substance, and even the arguments presented cannot be verified. So even when they are getting some reasoning or they are getting some arguments, they don't know how to validate and verify if this is the actual truth. The second problem is overvalued or underperforming investments that create risk by tying up capital in hard to trade assets, meaning you cannot resell your property, for example. This limits liquidity and causes missed opportunities for better returns. And this is a very important one. Missed opportunities for better returns. You can only spend that money once. You can maybe have a lot of money and buy multiple properties, fantastic. But at the end of the day, when we invest our money and it gets stuck, it's stuck. And basically, we are the ones paying the price for that. We can only pay it once. We can only invest it once. So what is the result of these problems? The first one is your liquidity is locked. It makes it very hard to basically sell your unit, or sometimes it's not even possible to sell your unit. On top of that, we have your investment that stagnates because of that, or it could even decline and become worth less than what you paid for it. And you actually see this in the market. So with the current inflation, you are basically booking a major loss. And thirdly, you miss out on higher returns opportunities. There are great opportunities in the market that still perform very well, and they are hard to find, but you certainly find them, and definitely you will find them when you understand the market and when you are connected to the right people that also understand the market. And your only job is to then validate these opportunities and make sure that they align with your investment objective. So you don't want to have that cost of opportunity, because obviously that results in the biggest losses over time. Common pitfalls and facts. So marketing versus data. The promotional talk, the sales, the marketing, the brochures, the claims, we need to be able to validate that versus hard transaction, factual data from the Dubai Land Department. These are sales transactions, but also lease contracts. And we can see when property was purchased, when it was resold, for how much was the markup, and we can basically understand the entire life cycle of each and every transaction from each and every project for each and every developer. So yes, that's a lot of language, that's a lot of information, but it's good because we are able to dive into that and basically understand the value and the value over time. On top of that, the lease contracts can help us define what is the return on investment. Then we have the DoD REST application. This is from the Dubai Land Department. And basically, we can see property related tests that you can do yourself on this app, but you can also get information on the brokerage, on certain projects, the progress, and so forth. Other than that, you can't calculate returns based on Airbnb booking costs from just one day of the year. What do I mean by this? When we have claims of return on investment and when we get a booking fee for one day of the year, let's say that day is 31st of December, obviously, because of New Year's Eve, that price is going to be massive. But we need to understand what is the average price that people are paying for the year throughout. What's the occupancy? What is the average rate? And basically, what are also the fees that we're paying on top of that? So you cannot just calculate your ROI based on one listing or based on one price that you see online. Other than that, understand and recognize the area and its potential and risk plus track record. So this is something that I hammer on a lot. Per area, you can define what is the strategy but also what is the risk involved with that area. When it's empty land, it takes a lot of time before that land is going to be developed. Then who is going to develop that area? We also need to look at their track record and basically what have they done and how did it perform in the past. So when you are selecting property and it's in a certain area, you first need to understand what is the label of that area. Is it empty? Is it emerging? Is it established or is it saturated? And based on that data, you can basically understand and assess what is the value of the project and am I willing to take the risk associated with this area? So always make sure that you validate this information with the Dubai Land Department data as it records all the property deals and leases of the Dubai market. So when it comes to recognizing risks, first of all, is it an emotional purchase? Am I buying out of emotion or have I assessed it in depth? And is it aligned with your expectations and objective? So when it comes to home buyers, to living yourself, you have different criteria. When it comes to an investment where you want immediate rental income, you're not going to buy off plan. So then when it comes to recognizing risks, am I making an emotional purchase or not? Am I being influenced? Am I being triggered by certain words? Am I being triggered in a certain way that makes me make an emotional purchase, which can still be fine. Like you can still be excited about your purchase, but at the end of the day, you need to make sure that it's assessed and it's aligned with your expectations and objective. You need to define what is your expectation. You need to validate that and you need to have an objective. And if you are making an emotional purchase and you have not defined a strategy or being able to assess your investment, then you're probably taking a very big risk. Have I thought through the investment and am I confident or not? Ask yourself this question. Have I checked the developer's track record and have I looked at the price and quality ratio? What price am I paying versus what quality am I getting? Basically, am I paying a premium or not? Or am I getting a discount? Now, when it comes to off-plan, are there any hidden restrictions like an NOC that we require from the developer in order to resell the off-plan investment? NOC stands for non-objection certificate, and the developer is required to issue that before you can resell your unit. So when is it issued? At what percentage of the payment plan? And does that make sense with when I am planning to sell that unit? For example, if you are looking to sell it halfway through and you get an NOC halfway through, then that's great. But if you only get an NOC at 60% and you are looking to resell it after 30% and in a very short time frame, then you don't have sufficient time and you basically need to pay a big installment before you can resell your unit, or your buyer needs to pay that for you, which is also a possibility. Other than that, check if your broker is restricted. Are you dealing with a broker that cannot sell the area that you might want to have a property in? Some brokers are restricted, so be aware of that. Always remove rush and pressure. Yes, there are launches that are selling out very quickly, but remove the rush and pressure from your side. Don't let people rush you. First understand it, and then when the time is right, you're at the right launch, you have the right contacts, then sure, you can make a fast decision. But there is a very big difference between making a conscious fast decision versus being rushed by others. Then review the SPA, the sales purchase agreement, in depth It's a contract, it's the leading contract of the purchase. And ensure what you see is what you buy. So when you go to a show apartment and you see great quality, great appliances, and so forth, also confirm that you actually buy that in your sales purchase agreement. Sometimes it's overlooked and you are the one dealing with the consequences. Then lastly, the risk of project delay. How will it affect my investment? So when we are selecting off-plan projects from certain developers, we can always look at their track record and history of handing over property in time. But it could happen that there are delays. So we need to understand when it delays, how is it going to affect my ROI? And basically, what do the clauses of the contract say about that? Are we going to get compensated? And if so, when and how much? Other than that, we have legal protection. So basically, as a foreigner, you can purchase in the freehold areas where you have 100% ownership for foreigners. There's also leasehold areas where you can still purchase, but you have an underlying lease of 99 years. Hence, a lot of investors, they only choose to purchase in freehold communities. We have escrow compliance, meaning that every off-plan requires an individual escrow bank account, which is monitored and essentially co-managed by the government. So every 4 months, the Dubai Land Department basically goes to the project, inspects it, and once they check off all the boxes, then only the developer can withdraw some more money from the escrow account and put that towards the project. Then again, after 4 months, they have an inspection and the same thing happens. Then we have the DLD. They manage the ownership transfers and they basically make sure that it's a smooth transaction, that the check for the seller, for example, only gets released after the title deed is issued on the buyer's name. This is for a ready transaction. And then there are security deposits towards every single property purchase, which ensures that both parties are incentivized and basically putting money down to make sure that that property is going to be purchased or sold. Then we have the RERA, which is the Real Estate Regulatory Authority that regulates developers, brokers, but also the escrow compliance. And this is something, again, you can also check yourself from the Dubai Rest app. Then we have Sharia law, which basically applies to the ownership of property, unless we otherwise agree on that through a will. So a will can be issued through the Dubai courts. And in terms of death or anything unfavorable, basically we set the rules for how the property will be handed over. This is often more favorable for foreign investors because this is what they are used to in their home countries, unlike Sharia law. Then we have the Rental Dispute Center, the RDC, and this resolves any tenant and landlord issues rapidly whenever that occurs. So that could be related to late payments or certain fixes in the apartment that are not being done. And basically any of these type of cases can be easily handled and quickly handled by the RDC. They take it very serious. It's not expensive and it's very fast. Other than that, the financing possibilities for non-residents, they can basically finance 50 to 60% of the property value, depending on the bank approval. So that's something that can be explored. But be cautious with aggressive payment plans and over leveraging. If you are entering into 1, 2, 3 different off-plan projects, and next to that, you're going to buy a few more properties that you finance at a very high rate. Just be cautious that you are not over leveraging. And at the end of the day, you still need to be able to make your payments. Now, when it comes to rent or exit, so short versus long-term rent comes with pros and cons. For some areas, it's very favorable to rent out short-term and it gives higher return on investment. But for some areas, it's more favorable to just rent it out for the long term. So it needs to be defined and understood per area. And also ultimately who's going to manage it and how much am I paying in fees for that. But when it comes to other pros and cons, some of the pros for the short term is that you can still access the property, but the cons are that you have a higher maintenance fee, for example. When it comes to long-term rent, your tenant has a lot more rights. So you can basically only have them to vacate the unit after you give them a 1-year notice that needs valid reasoning. You have 3 type of reasons for that. Other than that, you can only increase your rent by, let's say, 5 to 20% depending on the RERA rental index calculator. Short term, you can still rent it out. Long term for the then market value, and it's vacant, so it's also easier to sell it. You can charge market rate values for the tenant because it doesn't have the same rights as a long-term tenant. When it comes to selling your off-plan, validate through the data if it's possible at all, but also is there demand and how much is the demand? If that's the case, then you can sell your F-plan through assignment pre-handover. So when you have made a certain gain on your off-plan and you want to resell it with an NOC, you are basically able to do that. But why are people doing this? Sometimes they gain 20% in a year and they only paid 20% of the off-plan project, which means that's a 100% gain versus the investment. So that could be a valid reason to sell your off-plan. And we still see this sometimes in the market, but I would say less than 1% where you can do this probably for all the off-plan projects in Dubai. And the last point when it comes to reselling your property, are we selling at an end user? What are their motives to buy? Or are we selling to an investor? In an ideal situation, you're selling it to an end user. These are often more, let's say, emotional purchases. So you tend to get a higher price for end user properties. Then finally, we have tips and checklists. So basically we have smart acquisition. Look at your cash flow management versus the payment plan and your timeline. So each off-plan has a payment plan, and we want to make sure that that's matching with our cash flow and with our liquidity that we have available right now. Other than that, do we have a clear objective? Do we know where we buy, and what we can expect? Research the area and understand potential and risk. So think about the labeling. FX fluctuations and protection. So with all the currency volatility in the world, currently the euro is being strong versus the dirham because the dirham is pegged to the US dollar. And we can basically lock in a certain rate so that you know, hey, this is my budget and I match this with the payment plan and this is what I would be paying for the next couple of years. Because maybe in a couple of years, the euro gets much weaker than the US dollar, hence also to the dirham, and you cannot pay your payment plan and you are in a distressed situation, which you want to avoid. So protect yourself from that. Then, am I paying a premium? And if so, for what? And when I pay a premium, is this premium worth it? Has this premium basically performed in the past? So I know I pay a premium, but I know I get value and potential higher gains in return. Or am I getting a discount because maybe it's a new developer or it's a new area, or it could be anything. It could be lesser amenities and the price is very good. If I'm getting a certain discount, that could also return into higher gains. Then verify the developer and the project, evaluate the ROI potential and validate it with the Dubai Land Department data, and also evaluate the ROE potential. So how much potential capital gains am I expecting because of the current price per square foot is significantly undervalued? We can do the research and understand these figures to understand its potential. Then when it comes to due diligence and research, always do that. Research on the developer, but also on the contractor. You can look up their track record and what have they done even together in the past. Look at the quality of the materials and how good is the quality of those materials and is it meant for that specific purpose where it's placed. Then review the sales purchase agreement, review the terms, review the payment plan. Sometimes there are different possibilities that you can choose. So sometimes there is a post handover payment plan where you would be paying after the property is handed over. So when you are receiving rental income, you can basically pay off your payment plan. But sometimes that comes at a higher cost. So make that calculation and understand the different payment plan possibilities there are. Is resale possible? How and when can an NOC be issued? This is specific to developers and often even to projects. So always make sure that you understand that. And are there any restrictions? So sometimes you have a post-handover payment plan that cannot be transferred to the new buyer. And this could be a massive issue for the buyer. So make sure that beforehand you clarify this before entering into the contract. Then the practical tools and checklists that you can apply yourself. Basically, I've made a checklist for you. It basically summarizes all the different key aspects that you need to take into consideration before buying anything. So let's go over them briefly. Review the area, review its infrastructure and future plans. Look at the community and the quality of the community, but also the potential. So when we talk about an off-plan project and we look at the master community, okay, what's the community of this master community in the past? So we have a feeling with the rental landscape, but also with the community itself. The developer itself, what have they done? What are they known for? Research them online. The amenities, what am I getting for the amenities exactly? How is this going to positively impact my rental income? Then look at the price per square foot versus other off-plan projects, but also versus existing property in the market. Then a very important one is the built-up area versus the gross floor area. So built-up area is including balconies and outdoor spaces, could be parking inside a villa and so on, while gross floor area is basically the livable space internally. So when you do a price comparison, always look at these different aspects. Then is there resale opportunity? Is there a market? How liquid is it? And am I getting the NOC? Then the plot and its view. So how is the view of the plot currently? And what are future projects going to do to that view? Because sometimes people have bought into areas where they have full Burj Khalifa view, and 3 years later, or sometimes 1 year later, they start building right in front of you. So you can already know this beforehand because every plot is registered in Dubai and you can see the purpose of that plot. So before making any purchase, always look at the plot and the future plans. Is the broker restricted and how are they of value to your purchase? Ask yourself this question. Before purchasing a property, inspect it. And before accepting a property for off-plan, also inspect it. So make sure that you understand in depth if the property is in a good condition, and if not, how this can be fixed before you accept it. And lastly, portfolio diversification. Make sure that you have a healthy, well-diversified property portfolio. So in summary, and to wrap this up, you make money by buying right and not by rushing. So thank you so much for your attention. I hope this was of great value to you. Now there's two options to go from here. You can either figure everything out on your own, or you can book a free strategy consult with me. Down below is the link, and looking forward to speaking with you there.